Welcome back everyone. I hope you're having a great day. And in this video, we're going to take a look at 5 stocks to keep on your watch list for this upcoming trading week. And as earnings season continues, we have some major results coming out from some of the top companies on the market. And going forward, all 5 stocks in this video offer their investors some nice long-term share price appreciation, and a few of them do pay out a nice growing dividend every single year. And if you're new to the channel, every single Sunday, we take a look at the best companies to have on your watches for the upcoming trading week, and these are the brands who are releasing their latest earnings, are hosting a presentation or a conference, or have a new product launch, or in reality, any major event that could impact the share price over the next few days, leading to some great buying opportunities. And before we take a look at the first stock in this week's episode, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe to the channel for the daily videos, and stock number 1 included in this Sunday's episode is ticker ATVI, which is Activision Blizzard. They currently trade for $91 per share, and the company is up by 43% over the trailing 12 months, and this is one of the leaders in the software and video game sector, and they have a market cap at above 70 billion and are trading with a very reasonable forward PE of only 24.89 for such a high growth industry. And they do pay out a slight dividend with a yield of only 0.52%. And recently, as the entire market has shifted away from these big tech and software companies towards the more traditional value plays, ATVI is on a slight decline of around 12% from their most recent high, so a nice little dip on the company right now, which may mean it's trading at a much more attractive level than where it was only a few weeks ago. And if we take a look at their investor presentation, this company owns some of the largest and most popular video game series on the market, such as Call of Duty, World of Warcraft, Candy Crush, and many more. And going forward, all 3 of their business segments are projected to grow for many years to come, and this pandemic has only increased the demand and the entertainment factor of video games as consumers are spending more time indoors. And throughout 2020, all 3 of their business categories saw amazing revenue growth. Call of Duty in 2020 grew 78% year over year. Blizzard and their wide variety of products grew 11% in total sales over the prior year as well, and King, the company that they acquired who owns Candy Crush, grew 7% year over year, and their income grew 16% over the prior year as well. So 2020 was a great year for this company, and as a software-based name, they have a rock-solid balance sheet. And if we take a look, as of year-end 2020, they had cash and investments of $8.82 billion, gross debt of $3.65 billion, and their net cash position was at over $5 billion, which is very strong. And for 2021, they've increased their annual dividend by 15%, and they're going to be purchasing back $4 billion of stock over the next 2 years, which represents more than 5% of their current outstanding shares at this current level. And they do report earnings this week, which is why we're discussing them in this episode, and they report on May 4th. We have a revenue estimate of $1.78 billion, with earnings per share to come in at 69 cents. And over the past 4 quarters, they have beaten expectations every single time, and we're projecting 20% EPS growth over the prior year. And although when you invest in Activision Blizzard, you're here for the long-term share price appreciation, which has been phenomenal over the past 5 years. But we have to mention, they do pay out a very slight dividend with a yield of only 0.52%. Their payout ratio is extremely tiny, making up only 13% of their total net income. So over the long term, a ton of room to continue to grow that payment at a very fast rate. And like we saw, their 2021 dividend just got bumped up by 15%. Their average annual growth rate is right around 12.5% per year, and they've been increasing that payment for 11 consecutive years. And going forward, analysts have some big expectations for ATVI, and they're projecting 17 to 18% per year share price appreciation over the next 5 years in the future. And at its current share price, it is well below the current price target that sits at $113, and the company is considered a buy at their current level. So definitely a very interesting company to take a look at this week if you want exposure to the video game and software sector, which is only projected to grow and expand for many years to come. And now if we continue on and take a look at stock number 2, it is ticker PYPL, which is PayPal. They currently trade for $262 per share, and over the trailing 12 months, they are up by 113%, and over the longer term, this has been the leader in the fintech sector. They have a current market cap at $308 billion, and they're one of the most trusted brands in the digital payment space. And over the past 5 years, they have seen incredible performance, growing 569%, which is absolutely insane. And similar to ATVI, as of late, the company is on a slight downtrend from a high point of $304 per share. They have now fallen by 14%, back down to their current level. And going forward, up until 2025, PayPal has some major growth potential, and they're expecting 20% annual revenue expansion to over $50 billion by 2025, and their annual earnings are projected to grow at 22% per year for the next 5 years as well. So over the medium term, the company expects they're going to more than double their total revenue and income by 2025. And if they can achieve these goals, I believe they'll be worth a lot more than where they currently sit right now. And of course, they do report earnings this week. We have a revenue estimate of $5.9 billion with earnings per share of $1.02, and the earnings report comes out on May 5th. We have some mixed results, 19 upward revisions and 13 downgrades, and over the past 4 quarters, they have missed once in Q1 2020, but have followed up by 3 consecutive major beats, and they're projected to grow earnings by close to 54% over Q1 2020. So a big report coming out from PayPal, and we'll see how they performed to start out this calendar year. And if we jump over to their income statement, they have performed extremely well over the past 5 years, more than doubling their total revenue from just over $10 billion back in 2016 to over $21.4 in the trailing 12 months, and a nice consistent increase every single year. And like we saw from their projections, that has no signs of slowing down anytime soon. And their net income has also been expanding as well to over $4.2 billion in the trailing 12 months. And analysts are bullish on this company as well, and they're projecting 23% annual share price appreciation over the next 5 years, and at the current level, they're sitting well below the 12-month expectation of $310, and the company is considered a strong buy at a 1.8. So PayPal, I believe, to be the leader in the fintech sector. I know there's competitors like Square who also report earnings this week, but I think over the long term, PayPal will continue to grow. They have the strong brand loyalty. I think their sales are going to hit that 20% average expansion. And over the next 5 to 10 years, I do believe the entire financial tech sector as a whole will see some massive growth, and PayPal will reap the benefits. So this is company number 2 in this week's episode. They report earnings as well, strong history, strong projected growth going forward, and definitely worth taking a look at this company on their 14% decline. And now if we move along and take a look at stock number 3, it is ticker DKNG, which is DraftKings. They currently trade for $56 per share. They're up a massive 191% over the trailing 12 months, and they have a market cap of $22.53 billion. But like the first 2 companies in this video, they also have seen a nice decline as of late, bringing the share price back down to a much more reasonable level. And from a high point of close to $72, they have now fallen 21%, back down to the $56 range. And if you're unaware, DraftKings is the leading company in the online gambling and sports betting industry. And currently, they're operational in 12 states, and they're the leader in the sector, and they're the only operator who is active in all 12 states right now. And DraftKings' current market is nowhere near its full potential. And at this current point in time, only 27% of the US population has access to legal online sports books, and only 11% has access to legal digital iGaming. So right now the market for DraftKings is still very small, but over the next decade, it's projected to grow annually by a very fast rate as more and more states legalize these activities and the potential for DraftKings to grow is only exponential going forward. Right now, the company is still the market leader in this industry, and only 27% of the US population has access to their services, so another 73% of the population over the next few years should lead to some major expansion in the company's total revenue. And DraftKings reports earnings this week as well, and the numbers come out on May 7th, and we have a revenue estimate of $232 million and a loss per share of 45 cents. And if we take a look, over the previous 4 quarters, they have missed on guidance every single time, and even though we're projecting a 148% increase over Q1 2020, they're still projected to lose 45 cents per share. And going forward throughout this year, although it is major growth numbers, they are projected to continue to lose money throughout 2021. So if the company does miss on these expectations once again, and the share price continues to fall, it may become a much more attractive level to buy DraftKings over this upcoming week. But over the longer term, analysts are still bullish on this company, and they expect 30% annual expansion over the next 5 years, and at this current level, they are trading well below the 12-month expectation of $73 per share, and they are considered a slight buy, coming in with a 2.2. So another interesting growth company to take a look at right now. They are losing money every single year, but they're operating in a very fast-moving industry that's nowhere near its full potential. So definitely worth taking a look at if you want exposure to the online gambling and sports betting industry over this upcoming week. And now we're going to move on and take a look at stocks 4 and 5 in this episode, and these companies are very different than stocks 1, 2, and 3. The last 2 names we're going to go over are boring, consistent, slow and steady growers that pay out a nice dividend every single year. So no 20 to 50% annual expansion expected, but consistent returns over the longer term period. And stock number 4 is Pfizer, ticker PFE, currently trading for $38 per share. And although this is the company that's helping get us out of this global pandemic, the company's trading somewhat flat with a slight gain of only 0.76% over the trailing 12 months. And at this current level, they have a market cap at $215 billion, a nice dividend of 4% at this share price, and a very, very low forward PE of only 11.64, so a ton of value coming from this name at this current share price. And over their latest quarter, they showed some great expansion, and total revenue was up 11% year over year, and their diluted earnings per share did grow 14% as well. And throughout 2021, the company's projecting a major expansion due to the pandemic and different operations taking off as of late. And they're expecting total revenue to come in right around $60 billion, which would represent 41% growth over 2020, and they're expecting earnings per share between $3.10 and $3.20, which represents a 38% growth rate over 2020 as well. So the company is projecting a major increase over this year, even though it's usually a slow-moving name. And if we take a look, their earnings come out on May 4th. We have a revenue expectation of $13.63 billion and earnings per share of 77 cents. And over the past 4 quarters, they have 3 beats and 1 miss, and we're actually expecting a slight decline in year-over-year EPS. And if we take a look at the company's dividend, right now you can buy in with a nice high yield of 4%. The annual payout is $1.56 per share, and we can see if they hit their projection of around 3.10 or 3.2 for this full 2021 year, that means their annual dividend will make up around 50% of their total net income. And right now, the payout ratio sits at 47%. Their annual dividend growth rate is at around 6% per year, and they've been growing it for over a decade. And going forward, for even such a large and stable company, they're projected to grow by 10% per year. Tie in that 4+% dividend that is still growing annually, you're looking at a nice high mid-double-digit rate of total return coming from Pfizer. And at this current level, they are considered a slight buy or somewhat of a hold at a 2.6, and the share price of $38 is just below the 12-month expectation of close to $40.70. So this is definitely a more boring company, not too exciting, but they are projecting some major growth throughout 2021 of over 40% revenue expansion, close to 40% growth in EPS, and the company does share earnings this week and offers their investors a ton of value with a very low forward PE and a nice high dividend, just above 4%. So they were stock number 4, and now if we transition into company number 5, the final name we're going to go over in this Sunday's episode, it is ticker CVS, which currently trades for $76 per share, and the company is up by 24% over the trailing 12 months. And at this current level, they have a market cap right at $100 billion, and they're one of the top value companies on the market right now with a forward PE just at 10, which is extremely low, and their current dividend yield comes in at 2.62%. And over this upcoming week, the company does report earnings on May 4th. We have a revenue estimate of $68.3 billion and EPS of $1.72. And over the past 4 quarters, they have actually beat expectations every single time, and they're forecast to actually decline by 10% over this latest report. And going forward, in late 2021, we are expecting some decent pickup in their total EPS. And if we jump over to the company's income statement, although they are a boring name in the pharmacy space, they have been growing their sales every single year. And we can see 177 billion, then 184, 193, then a mass expansion in 2019 up to 255, and now in the trailing 12 months, even though retail was hurt all across the country, they have now generated over $269 billion of total revenue over the past year. So although this company is considered boring, they're not really exciting, we all know what they do, I'm sure we've all shopped there, their total sales are still expanding every single year as they try to grow internationally as well. And they've generated over $7.1 billion of total profits in the trailing 12 months as well. And at this current level, their dividend yield is at 2.62%, their payout is $2 per share, and that only makes up around 26 to 27% of their net income, which is very low and very sustainable. And going forward, analysts are not really forecasting that much growth in this company, but I think they're a little bit too bearish. Right now, only forecasting around 4% annual share price appreciation, add in the 2% dividend, you're looking between a 6 and 7% annual return if these expectations are correct. But I think the company is very cheap right now. I think they are considered slightly undervalued and will return a little bit better than what these analysts are forecasting going forward. And right now, they are trading well below the 12-month expectation of $87 per share, and they are considered a buy, coming in at a 2.1. So CVS is definitely worth taking a look at this week. I'm looking forward to seeing how their latest earnings come in. They are more of a traditional company, but they're trading with such a low valuation and a forward PE of only 10, I do think is getting attractive at this current share price. So now we're going to wrap up the video. In this episode, we went over 5 stocks to take a look at this week. As we do every single Sunday, we went over the companies who are sharing some news events over the upcoming week. And like we saw, all 5 names in this week's episode are sharing their latest earnings. And as we continue on through this earnings season, I think many of these big name companies will become very volatile. Some will miss expectations, some are going to crush them. And I think going forward, the overall market will be very interesting to come up throughout the month of May. So I want to thank you for watching to the end. If you're new to the channel, please hit that like button and subscribe. Join the community. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.